Right now, as we look at the live markets, Opendoor Technologies Inc. is trading at exactly $6.50. That is a significant intraday move, showing a gain of 0.34 cents or a 5.52% jump in a single trading session. When you see a move like that, over 5% in a matter of hours, it naturally triggers a rush of adrenaline for anyone holding the bag or watching from the sidelines. It demands attention because it defies the prevailing logic that the housing market is currently in a deep freeze. Most casual observers look at that green percentage and assume it is simply a reaction to a headline about interest rates, or perhaps a broader sector rotation where money is flowing back into beaten-down tech stocks. That is the expectation, that this is just standard market noise or a dead cat bounce in a sector that has been hammered by the Federal Reserve. But here is the reality that is much more interesting and far more dangerous for those who do not understand the mechanics under the surface. This movement is likely part of a calculated high-stakes chess match between the company's management and a legion of short sellers who have been betting on this company's bankruptcy for the better part of 2 years. What you are seeing at $6.50 isn't just a stock price. It is a battleground where structural changes to the company's capital structure are colliding with a macroeconomic environment that is confusing almost everyone. To understand why this 5.52% move matters, we have to look beyond the simple ticker tape. If you are an investor who usually sticks to blue chips like Apple stock or the high-flying momentum of Nvidia stock, the volatility of Opendoor might seem nauseating. However, for the traders who live for asymmetry, this is the most fascinating chart in the market. The expectation for Opendoor has been clear for a long time. High interest rates equal death for the iBuying model. The logic holds that if mortgage rates stay above 6 or 7%, nobody moves, inventory stagnates, and Opendoor, which relies on volume, bleeds out. That is the bear thesis that has attracted massive short interest. But the reality surfacing today is that Opendoor is fundamentally changing how it operates, shifting from a capital-intensive house flipper to a leaner, asset-light marketplace, and today's price action suggests that the market is starting to sniff out the possibility that they might actually pull this survival act off. When you see the volume spiking alongside this price increase, it indicates that institutions are potentially reassessing the risk-reward ratio here. Or more likely, short sellers are getting nervous about the CEO's recent aggressive moves to defend the stock price. Let's talk about the actual trading dynamics we're seeing right now. The volume today is significant, confirming that this isn't a low liquidity drift. This is active accumulation and covering. If you are managing your own capital through self-investing strategies or using investing sites to track flow, you will notice that Opendoor often acts as a leveraged bet on the 10-year Treasury yield. When yields dip, Opendoor rips. But there is more specific friction here. The management recently issued a warrant dividend, a highly unusual move designed to punish short sellers. By distributing warrants to shareholders, they forced anyone shorting the stock to effectively owe those warrants to the lender, complicating the short thesis and increasing the cost of betting against the company. This is the kind of financial engineering that can trigger violent upside moves like the one we're seeing today. It's a reminder that while you might use Schwab Intelligent Portfolios for your safe, long-term compounding, stocks like Opendoor require a much more active, almost combative mindset. You're not just investing in a business, you're stepping into a ring where the mechanics of the stock float matter just as much as the number of houses they sold last quarter. It is crucial to contextualize this for the retail investor. If you are using the Robinhood app or looking at Robinhood stock trading charts, you might see this 5% pop and feel the fear of missing out. But you must understand the difference between a momentum trade and a fundamental turnaround. Opendoor is still navigating a housing recession. The gap between expectation and reality here is that while the macro environment is terrible, The company's unit economics are arguably the best they've been in years. They have widened their spreads, meaning they're making more money per home flip than they did during the boom times, even if the volume is down. This is the counterintuitive signal. The market expects them to be desperate. The reality is that they are being disciplined. They are refusing to buy bad inventory just to show growth. This discipline is what is supporting the price at these levels, preventing the collapse to zero that so many bears predicted. Now let's take a step back and look at the company itself. For those who might be new to the story, Opendoor is the pioneer of iBuying, instant buying. The premise is simple. You want to sell your house, but you hate the process. You hate the open houses, the staging, the uncertainty of when it will close, and the risk of the buyer's financing falling through. Opendoor steps in and uses algorithms to make you an all-cash offer. They buy the house, do minor repairs, and put it back on the market. In the past, during the era of 0% interest rates, this was easy. Money was free, and house prices only went up. You could buy a house, hold it for a month, and it would appreciate on its own. Opendoor was essentially paid to borrow money. But when the Fed hiked rates, that tailwind became a massive headwind. Suddenly, holding a house cost a fortune in interest and home values were falling. This is why the stock collapsed from its highs. However, what most people miss is the pivot. Opendoor is no longer just trying to be a massive flipper. They're building Opendoor Exclusives and partnering with channels like Zillow. They're trying to become a marketplace where they connect buyers and sellers directly, taking a cut without always taking the balance sheet risk of owning the home. This transition is painful and slow, but it is the key to their long-term survival. This brings us to the broader landscape of online investment and how different platforms categorize a stock like this. If you look at Fidelity Investments, particularly their research on Fidelity mutual funds or Fidelity ETFs, you will rarely find Opendoor as a top holding in conservative funds. It's considered a speculative growth asset. The Fidelity Wealth Management arm would likely advise clients to limit exposure to such high beta names. However, on the Fidelity trading platform, you see a different story. Active traders use Opendoor as a proxy for the real estate market's pulse. Similarly, users on SoFi Invest or those engaging in SoFi active investing often flock to Opendoor because it has that tech disruptor DNA that appeals to the younger demographic. It sits in that same mental bucket as SoFi stocks or Robinhood crypto plays. High risk, high potential reward. Even the interactive brokers trading crowd, which tends to be more sophisticated and institutional, watches this ticker closely because the options premiums are juicy. The implied volatility is always high, making it a favorite for those selling puts or calls. The macroeconomic pressure cannot be overstated. We are currently in a lock-in effect. Homeowners who have a 3% mortgage rate are simply refusing to sell because buying a new home would mean taking on a 7% rate. This has crushed transaction volume to levels we haven't seen in decades. The expectation is that this volume crunch will bankrupt Opendoor because they need transactions to feed their machine. But the reality, and this is the deep contrarian take, is that Opendoor might be the only solution for the people who must sell. If you have to move for a job or a divorce, you need speed and certainty. You can't wait 6 months for a buyer in a frozen market. In this way, the tough market actually validates Opendoor's value proposition more than a hot market does. In a hot market, you can stick a sign in the yard and get 10 offers. In a cold market, Opendoor's liquidity is a premium product. This is the nuance that the 5.52% move today is hinting at. The market realizing that Opendoor has utility even in, or perhaps especially in, a crisis. Now let's pause for a second and gauge the room. The housing market is something everyone has an opinion on because everyone has to live somewhere. Comment below how many shares of Opendoor you currently hold, or if you're staying away, tell me, Do you think the housing market has bottomed, or is the worst yet to come? I want to see where the sentiment is among real investors. Continuing on the analysis, we have to look at the competition. Zillow and Redfin tried iBuying and failed. They shut down those divisions, took massive write-downs, and walked away. This left Opendoor as the last major player standing. For a long time, investors viewed Zillow's exit as proof that the business model is broken. If Zillow couldn't do it, how can Opendoor? That was the refrain. But the reality is that Zillow was bad at it. Opendoor's algorithms and operational discipline have always been superior. Now Zillow is actually a partner, sending sellers to Opendoor and taking a referral fee. This validates Opendoor's technology. It suggests that the future of online investing in real estate isn't about one company doing everything, but about an ecosystem where